Okay, let's address one stock which has really been taking a pounding, and I just want to bring up the intraday chart of Quess Corp and show you how it's currently panning out after taking quite a bit of beating off late. Can we have that intraday graph first before I take it across to Ajit, the CMD at Quess Corp? Still lower by about 18.5% right now. So let's hear it out from the horse's mouth as to what really is the concern. Ajit, hi, afternoon. Ayesha here. Good to have you on the show with us. Help us understand what really is the concern in the market with regards to receivables. I mean, and what explains this kind of vicious stock price fall?
It's a bit of a strange situation because our receivables position has not changed at all over the last 2 quarters. In fact, our cash collection has only improved from what was 30% last year to about 43% that.
Mr. Isaac, are you with us on the phone line? Mr. Isaac, oops, I think we do need to reconnect because there is a lot of concern in the market. Some say that it's an annual report and there's some concerns that have been flagged off over there. Is there an issue with the receivables? Is it another case of Cox and Kings? You know, there's just rumors floating about that maybe Thomas Cook is interested in looking at Cox and Kings, and that may change the dynamics within the sector. But do remember, it's been a stark underperformer. Pull up the one-year chart as well, and you'll know what I'm talking about as well. The working capital cycle has also been stretched. Margins have been flat. So all of that really seems to be weighing down on the stock. There you have it. The performance this year has been rather bleak. Down in the last 52 weeks by about 61%. That's the stock in focus. I also want to take cognizance of what's going on with respect to the Essar Steel verdict. The NCLAT has rejected Prashant Roya's plea. This is against Arcelor's bid for Essar Steel. So that's the latest development coming in. Remember, this too has been going on as a case for quite some time. The latest had been that the NCLAT had approved Arcelor's plan for Essar Steel India. They have now rejected Prashant Roya's plea against the bid for Arcelor. So this definitely coming in as a bit of a setback. Remember, the appellate tribunal had in mid-May heard the contentions of all of the parties. They had reserved the judgment with respect to the case for ArcelorMittal's plan for Essar Steel. And now the latest is that they have rejected Prashant Roya's plea against the bid for Essar Steel. Do remember that the Supreme Court had halted the distribution of funds among the operational and financial creditors from the firm's 42,000 crore resolution plan for Essar India, and this had happened in the month of April. Okay, right back to Ajit Isaac, CMD at Quess Corp. Apologies for that. The lines seem to have gotten cut. Please do go ahead. What is the position with receivables right now on Quess?
Yeah, so I was saying that our receivables position, in fact, has improved in the last has improved dramatically in the last 3 quarters. We had EBITDA to free cash conversion ratio of about 30% last year. This year, we finished at 43%. Last quarter, in fact, was up 55%. So I think the numbers are very different from what a perception is. As a management team, for us, it is business as usual. We think that our metrics are improving. And in fact, in sales growth, we've had very good sales growth across the company. So our debt levels have further come down by 200 crores this year. So all indicators are showing otherwise than a perception that there is a receivables position.
Can you just fill us in with what have been the latest updates from your annual report? Have there been any forthcoming projections that are concerning the markets, perhaps?
I don't think we don't have any acquisitions coming up. We just concluded one with Allsec right now, so we don't have any contingent cash requirements coming up. In fact, we recently had an initiative to get into a strategic partnership with somebody and through which they would invest about 51 odd crores into our company, which our board wants certain additional information on, and which we'll go back to the board with. And you will get to hear more about this as we keep moving closer to the event.
Can we take that on record that the market concerns with regards to perhaps what the acquisition of Monster India Football Club, that's going to drag down your margins? You're completely rubbishing that fact?
I don't think Monster is going to drag down our margins. We have allocated about 30 crores of cash into the company this year. We don't see it going beyond that. And with the allocation of cash, we will still stay within the margins that we projected to the market. So I'm not rubbishing it, but I'm saying this is the fact.
You know, the other concern with the market is the perception of aggressive accounting. You know, what the concerns that we hear and most analysts as well at this point in time are raising, and I'm going to quote verbatim here, lower goodwill impairment, lower interest on loans to associates, lack of disclosure, etc. How would you like to clarify on this particular concern?
So a lot of this is actually third-party recommended, certified, verified numbers. It's not in-house numbers. What our auditors, what our associates in terms of practitioners of accounting suggest to us is what we do. We think we are following standard accounting practices in this, and it needs a certain clarification if required, which we are happy to do to anyone who wants it. So I think it's a perception that needs a little bit more depth to analyze before we conclude that it's aggressive.
Make that clarification, please, because I think that is what the market wants to hear.
Yeah, I'm most happy to do that. I'm happy to do that to anyone who would come up to us for.
Mr. Isaac, there was also the recovery of 150 crore revenue advance from the Smart City project, and there seems to be some uncertainty around that. Can you clarify what the status is?
Sure. So we implemented the Smart City project of Ahmedabad, which today has been almost complete, and it's been rated as perhaps the best smart city project done in India. So from a project completion standpoint, there is no issue. Out of a project size of almost 200 crores, we've collected about 55 to 60 crores. So we've received part of the cash. The other part of the money that's due to us, there's been a temporary lull in the clearance of cash from the contracting authority because of elections and everything that went on. A partner of ours in the interim, of who's doing it, who was part of the consortium that did this, went into bankruptcy and is going through a resolution process. So we have a separate escrow mechanism set up to be able to facilitate the receipt of funds through the escrow mechanism. As and when we receive the funds, we'll inform the market. Part of the concern could be that, how long will it take for the money to reach us?
The concern also, Ajit, is there is increased working capital which is resulting in higher debt. Help us understand what is your working capital at currently, what is the debt level, what plans do you have internally to try and retire the debt?
So if you look at our company, we do, approximately, let's say, give or take a bit, between 550, 600 crores of EBITDA based on the current projections and run rate. If you take a cash conversion of about 50% of that, we'll have 300 crores of cash. So all of the cash that we've got, either we can use that for debt reduction or use for fresh acquisitions. We've publicly stated that we don't want to do any more fresh acquisitions, and, our organic growth is what we're focusing on. So as an organization, a lot of the cash that we generate will go back into settling of debt. Our debt levels have come down by 200 crores as of date. And we'll keep coming down further. And, against an equity base, it's a very favorable number. So I think we are well poised to use the cash that we are generating to pay down our debt in the future.
You're taking to, reduce the losses at Monster, improve your working capital as you just spoke of. And can you just tell us how you're valuing the company right now? So,
well, as a promoter, to me, it's a very valuable asset. If I can buy stock now, I will still buy. I've been buying increasingly over the last month myself. We're in a silent period now, and therefore, we can't do any purchases. But I think our stock's very valuable. I think our best is yet to come. We've hit the sweet spot now where we're generating the cash, where we're using the cash for future acquisitions, and our operations are in very good shape. In most of our businesses, we are number one and number two in India: general staffing, professional staffing, facilities management, skill development. So if you can count up all these businesses, which are basically annuity revenue streams, they themselves add up to in excess of 600 crores of EBITDA. Then you count down how much you're spending on Monster, etc., which is about now 30 crores. So there's a disproportionate amount of noise on businesses that are turning around and need to get profitable, which are drowning out some of our businesses where we are actually number one in most parts.
Ajit, purely on the market dynamics as well, we all know that unemployment is at a 40-year high. IT sector has had a spree of low hiring of late. Wouldn't that impact your growth as well going forward?
Our employment, the staff that we're adding on to our company is in maybe areas that are seeing some growth. One. Second is our model has now become a non-linear business model where we're not necessarily headcount related. We may be the largest private sector employer in India today with about 330,000 people working for us. But a large part of our growth will actually come from businesses that we've added in the last few years, which are technology related and which don't necessarily move in a linear direction of growth. For example, in our BPO business, we have about 35,000 people working in that. And a lot of the work is moving to the non-voice, data type work. So if we, out of 600 crores of EBITDA, 140 crores comes from that. So our business mix is changing as we move along. And that, I think, is the real indicator of the quality of revenues that Quess is transforming itself into over time.
All right. Thanks so much for joining us, Mr. Isaac, on and clarifying some of the ongoings there and the concerns in the market.